Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's @_finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities and sharing those opportunities with everyone in the community. We do have a special coupon code going on. Special is the code. It's $25 for the first month only on the monthly membership, which is a 50% discount. And it's a $500 charge for the yearly membership, which is a $100 discount when you use that special coupon code. The U.S. home prices are rising again. The median home sale price rose 2.4% year over year in the 4 weeks ending November 9th to $393,700, the highest since August. This marks the biggest increase in 6 months, according to Redfin. Over the last 3 years, home prices have surged by $18,700 or 5%. Meanwhile, elevated prices, higher mortgage costs, and economic uncertainty are causing the homes that do sell to take longer to find buyers. Homes are now taking a median of 49 days to go under contract, the longest for this time of year since 2019. Housing affordability is somehow still getting worse. And there's the increase of 2.4% year over year going on in November. I thought we were supposed to have this big housing market crash. What is going on? Why are prices still going up? How come affordability is still getting worse? I don't know. Maybe we've got a shortage. Maybe the good homes are continuing to sell, and you know the demographic is larger than the homes available. I mean, that's ultimately what it is, right? If the demographic was, if supply and demand, if we had too much supply, home prices wouldn't be going up. So, but I mean, maybe it'll normalize. Maybe the price increases have been slower over the years. I'm curious to see if this picks up or not. Picks up in terms of faster home price increases out in the future. I see home builders, they don't look that bad. They look like they're bottoming, ready to turn higher, in fact, which is opposite of what I'm hearing on Twitter of all the perma bears out there in the real estate market. But so far, they're losing, and the bulls have been winning at this point. FI couple, 1 million of liquidity could be $80 to $100,000 a year of semi-passive income. That's more than most US households ever make in a year. So if you ever hear someone claim 1 million is not a lot, they're wrong. I here's something that a lot of people do that I don't hear too much. A lot of people always say if you have X amount of money and you invest it at interest rate Y, you get this amount of money. What if you take a different approach? And this is the approach that I take. What if you buy and find incredibly undervalued assets? Incredibly. Maybe ones that aren't paying a dividend today. You hold them for 5 years. You turn $1 million into $5 million, and then you get a gigantic payout of like $500,000 in dividends. And someone would say, well, that's not possible. I think it is. I absolutely think it is. Some of these commodity companies, they struggle at the bottom of bear markets in commodities. If they're a medium to higher cost producer, they don't make any money at the bottom. So they cut their dividend, they cut their spending, they cut their production, they cut it all back. Then when the commodity price comes back, they start making a whole bunch of money. They start to increase production. And all of a sudden, you're sitting on this big, fat, free cash flow cow of a company. And then they decide to either buy back shares or pay dividends. If you buy it in the wrong, in the we'll call it the it's not the wrong market condition, but if you buy it in the down cycle, and you hold it through the entire cycle, as you get into the cycle, you can get absolutely ridiculous dividends. People, I don't think they believed me on the website when I would talk about companies that I have purchased and I'm getting my entire amount back in dividends per year. So I put $10,000 into a stock, I get $10,000 a year in dividends 3, 4, 5 years later. And they're like, yeah, right. Then all of a sudden it happens to them. And they're like, holy crap, these dividends are huge. I think it's very possible. If you can buy cheap assets, and even if you do that with $1 million, I think you could easily beat $100,000 plus of semi-passive income. But it would have to be a few years out if you're buying it at the bottom of the market. And that's exactly what I'm doing with good chunks of my money. Some of them, they still pay dividends at the bottom. They'll just pay more dividends as the price of that commodity that they sell goes up, or the price of the day rate that they have, or whatever it is. And that's what makes me the most excited. I get so excited over opportunities that I see today that could net me 20, 30, 40, 50, 60, 70% dividends in the future of the money that I put in myself. It's not going to be a 50% dividend yield. It's going to be the yield that the money that I put in today would yield 5 years from now. And hopefully that makes sense to you. Melanie says an average family earning 1 million would get a tax cut of $277,000 per year. A family earning 73,000 would get a tax increase of $1,500. An average earning 38,000 would get an increase of $6,000. This is just another giveaway to the super rich at the expense of the rest of us. And there's a new bill in Congress that will get rid of income taxes and replace it with the 30% sales tax. Do you guys like this idea? Yes, because then everyone would be paying their fair share of taxes. And people would say, well, no, rich people need to pay more in tax. Why? Tell me why. I don't understand it. I pay a heap of taxes. In fact, taxes exceed my yearly expenses. Now, some people say, well, you just need to do it different. You need to spend more here and you need to do these write offs. Guys, I don't like this whole tax system. It's garbage. Let's get rid of it. And let's make everyone pay their fair share. Oh, you don't make a lot of money? Well, you don't have to buy stuff. If they put it on a sales tax, that is an elective thing. Go buy used stuff and avoid the sales tax altogether. That's what I would do. Be smart with it. At least you have the option. Now, if on income, they charge that right off the freaking bat. There's nothing I can do because everybody reports, 1099s and W-2s and all that stuff. But if they get rid of it, I'm all for it. Now, other people are going to be mad because they weren't paying any tax to begin with. And that's the problem. It's something like the top 10% pay something like 77% of all federal income tax, or 70%, or something like that. I don't see how that's fair. Now, a lot of people who don't make money, they think it's fair. That's not. I don't see how that's fair. How can top earners pay almost all the income, the federal income tax? That's not fair. Fair is when everyone contributes. And you know what's going to happen? If everyone's paying taxes, people are going to change the way that they vote. They're going to say, I don't like taxes. Let's reduce federal government. Perfect. But if all they're doing is buying votes by saying, oh, if you don't make a lot of money, you don't have to pay taxes, and then everybody votes for them, that's completely wrong. I think everybody should pay tax, and everyone should feel the sting, and everybody should, vote for lower government spending. I think it's that simple. Everyone benefits in that scenario. Here's a couple of quotes. So the entire financial industry is built around selling you the idea that you need to predict the future. The truth is that you only need to predict one thing. that the price you are paying today is low enough to survive any future you can imagine. When that condition is satisfied, the future stops mattering. You have transferred the burden of prediction from yourself to the seller who accepted your ridiculously low bid, says Nassim Taleb. I agree with that. I think it's completely true. Another quote from Howard Marks says, I've always found it an interesting fact that those who pay attention to valuation tend to do well over the long run, and they rarely get caught in bubbles. The reason is simple. If you buy something for less than what it's worth, or even for what it's worth, you're unlikely to get hurt badly, and you have the potential for gain. But if you buy something for far more than it's worth, as people invariably do in bubbles, you're risking a large loss. And the best you can do is break even when it returns to fair value. Thus, buying with this margin of safety, the key to sound investing, automatically keeps you out of bubbles, says Howard Marks. I totally agree with that. I came to that same conclusion without other people telling me that. I was like, well, every time I look at low valuations, they're always at bottoms of technical analysis patterns, almost always. And then when the valuations get really bubbly and big, it's like they do some vertical spike and they're very close to the top. That's the way that you can also distinguish between a bottom and a top, is through valuations of the assets that you're looking at, and those average valuations across the sector. Completely true. I'm going to go to some ratio charts. I was looking at this ratio chart, platinum to gold. Platinum to gold, again, you're in a certain market condition when you go from top to bottom. And I've just been watching this. I'm like, man, this is ready to break. So when we look at this corner here, we've got this big surge higher of the breakout of that downtrend, and we've got a squeeze in a pennant formation. This is ready to break at any second. What does that mean? Why does it matter? Well, when this breaks out, platinum outperforms gold. When platinum outperforms gold, it means you're in an inflationary environment again. Platinum outperforms gold when inflation is coming through the system. It tells you that you've entered a new market condition. Platinum outperforms gold in commodity bull markets, like this one there. So I think that we are at potentially the beginning of a commodity bull market when platinum breaks out against gold, which could happen at any second. And we're going to see that outperformance. Another ratio, platinum versus palladium. When platinum outperforms palladium, you're in the commodity bull market. It is part of the cycle. That occurred, it came to the bottom, and at these bottoms, in 1998-99, the commodity to stock ratio bottomed. And then this ratio bottomed and turned and went higher. That happened here in 2020. We were coming down, bottomed, and now we're starting to head higher in 2022, 2023, and so forth. The commodity bull is coming. It's coming, guys. We can see it through the ratios. Platinum versus palladium and platinum versus gold. We can also look at platinum versus silver. A platinum versus silver, silver is ripping it. I get it. So we could have one last big move in silver that brings this ratio back down and puts it into a slingshot. And I think that could occur and is occurring right now. We've got the big falling wedge. Now, we had a big outperformance of platinum versus silver the last commodity bull market. From 1998, it chopped sideways for a little bit. And then in 99, it took off and ran all the way to the top up here to the mid 2000s. This is 2004. So I think it's possible that we could get a slingshot here where we slingshot and platinum outperform silver at some point in the future when inflation is coming through the system. Now, platinum is more inflation sensitive than silver is. Doesn't mean silver won't go up. I'm just saying it's more sensitive. So hopefully that will be the case, because I own a heap of platinum. I also own a bunch of silver too, and I'm hedging myself against the changing market conditions. But longer term, they probably both go up. I think it's possible, if it's an inflationary environment, the platinum could go up at a greater rate than silver. Fingers crossed. Fingers crossed. We can look at some other ratios. I know some people they somebody wanted me to look at some ratios. So we can go through this. This is Baltic Dry Index versus gold. Look how cheap that is. The beginning of the Baltic Dry Index ratio was 1980. 1980. We came all the way down, and then we went into a big bull market from 1980 to the peak of 2007. That was the cycle. Now we've been in a down cycle here in the Baltic Dry Index against gold. Are we finally bottoming? I don't know. You have to wait and see, but this is down there, guys. This is way down there in terms of how cheap the Baltic Dry Index is. Very, very cheap. I think we are going to see a big move in the Baltic Dry Index. I think we're going to have to ship around a lot of commodities. I don't think there's any way around it. It's not like you can if you don't have copper in your home country, it's not like, oh, we're not going to ship copper anymore and bring it all home. It all depends on where the copper is located in the world. And then you got to go ship it all around. I think an energy, with what we're trying to do in energy, I think we're going to have to ship around a lot of commodities. A lot. So let's look at some of these other ones. Crude oil versus Dow Jones. We got the double, the double falling wedges here, and here we are still squeezing up in that corner. Let's see, crude oil versus gold. That's also a shoulder, head, shoulder, inverted. That's this pattern here. And then we're at the right-hand shoulder at the bottom, squeezed up into a corner. Looks fantastic for whenever crude oil starts to outperform gold. And I don't know if we get like a spike lower and a slingshot. It could do something like that. But that looks good for crude oil being cheap. Not good for it to break out yet, just that it's really cheap and a good formation. Crude oil versus gold, that's just another one there. Crude oil versus natural gas. You can see natural gas has been outperforming crude oil from the peak in 2024 and heading lower. So that looks good for nat gas. Crude oil versus palladium. Nice little squeeze up all the way to the bottom of 2020, 2021, and that's been heading higher. During the commodity bull markets, we've seen crude oil outperform palladium. Platinum outperforms palladium, crude oil outperforms palladium. I hope that we get something like this that comes, and that we've got our first kind of breakout, pullback, and then we get a big move higher. Because I'm positioned for crude oil to outperform. We've got crude oil versus platinum. That's also at a very low level right now. If you look at how cheap it is, this is about as cheap as it's gotten in history, all coming through there. So uh, crude oil is cheap to platinum. I like crude oil where it's at. Crude oil versus silver. That's also incredibly cheap, off the page cheap. So crude oil is off the page cheap to silver. Crude oil versus the S&P 500 looks like a double bottom playing out here, and we're all squeezed up here. So that looks good for crude oil in terms of its valuation, of how cheap it is. Crude oil versus uranium, it's cheap for crude oil. So crude oil is one of the cheapest asset classes out there. It's cheap against platinum, silver, gold, uranium. Let's do crude oil versus copper. I didn't look at that. I haven't looked at that in a long time. Yeah, this looks good for crude oil. It's like off the page. So I would say crude oil is probably the cheapest, one of the cheapest asset classes. Let's do crude oil versus iron ore. And crude oil looks good. This almost looks like a shoulder, a head, and a shoulder pattern. That looks interesting for crude oil being cheap. Crude oil is probably the cheapest asset on a ratio perspective of almost anything that I can think of. We could do crude oil versus coal. I know coal's real cheap, and that is, it got super cheap. Crude oil got super cheap in September of 2022. We were very expensive in 2014 for this particular ratio. It's kind of in the middle right now, kind of almost in the middle, maybe slightly cheap for crude oil. maybe the average is like up here. But yeah, crude oil versus Newcastle coal futures. It's advantage for crude oil. We can do crude oil versus met coal. That's average, right in the middle. So no real benefit there. So I would say of all the asset classes that we just looked at, I would say crude oil and coal is probably the cheapest of all of them. So those are the asset classes that are the cheapest. And I didn't look against lithium and stuff like that. Lithium could be cheaper too. But that's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special coupon code. And that's all I've got for today. All right, guys. Catch you later. See ya.